Thank you very much for joining us this morning. So this morning's session all about building up your nest egg. So I'm going to look at one of the key factors in the growth of your pension, which is of course market performance. So what we're going to do this morning for the next 20 minutes is just take a little bit of a look back at 2020, look at some of the trends that we've seen, and just have a little bit of a think of how those are going to kind of feature in 2021. I'm sure none of you need me to tell you that it's been a pretty unprecedented year. There's been a huge cost to global health as a result of the pandemic, but also to the global economy as well. So I thought it'd be good to kick off with just a rundown of how the scores look at the moment in terms of where economic performance is across the globe. These are OECD projections. You can see probably United Kingdom there somewhere near the bottom in terms of the table, and also in terms of performance, looking at 11.2% fall in GDP this year. The headlines write themselves, don't they? But I think if you look at other countries in Europe which have been badly hit by the pandemic, like France and Italy, you're seeing 9% drops there. Spain's not actually on this particular chart, but the OECD thinks that their economy is going to shrink by 11.6% this year. So a fairly similar picture for countries that have been hit the same. Now there are countries which have done better. You can see Germany there, 5.5% in the red, and actually some of the Far Eastern countries which have managed to isolate the virus, Korea and China, doing a bit better, and China actually expected to post some growth this year. But if you look forward into 2021, you can see that kind of wall of red turns into a wall of green. And actually what is expected is the global economy to bounce back next year. And of course, you would expect that because 2020 has been such a bad year. But that should be broadly supportive for equity markets. I think if we look at market performance so far this year, it's actually quite surprising. If you look at the MSCI World Index, so this is a measure of global stock market capitalization, it's actually at a record high, which, given what's happened this year, is pretty surprising. Now there are, a number of reasons for that. One is that policymakers have simply thrown taxpayer funds at the problem. We've also had central banks pumping up the economy using quantitative easing. Bond yields have fallen to close to nothing, and that's really meant that there's been nowhere else for money to flow apart from into equities, and that's bid up the price of the equity market. There's also an important thing that we need to look at within this, which is the composition of the global stock market. Again, might be surprising if we look at the MSCI World Index, which is probably the most widely tracked measure of global stock market capitalization. 2/3 of the world's developed markets are now in the US in terms of stock market capitalization. So quite a hefty amount there, and that obviously also speaks to why market performance has been so strong this year. Because again, if we dig down a little bit into the performance of various regional markets, you can see that actually the US, in terms of main developed markets, is far and away the best performer, posting a 15% return over the last 12 months. And you compare that with the FTSE All Share there at the bottom, unfortunately bringing up the rear. And you can see there's been a huge divergence in global markets. Now, actually, given what's happened this year, the FTSE in a way is a more normal indicator, and that given the economic shock, you would expect a fall in markets. But actually, if we kind of zoom out a little bit on that chart and think about the last 10 years, it actually looks fairly similar. You've got the US racing away, you've got the UK falling behind, and Japan and Europe somewhere in between. And there are a number of reasons for that. One is that the UK is home to lots of economically sensitive stocks in the main FTSE index, and economic growth, particularly in this country, has been fairly lackluster over that period. It's fair to say also that Brexit has had an impact. It has, I think, made the UK very unattractive for global fund managers, and actually for a lot of UK retail investors as well. If you look at fund flows for retail investors, quite a lot of it coming out of the UK and going into global funds, and indeed into the US. And on the flip side of the coin, the US economy has actually performed relatively well. Some of that, it has to be said, is probably down to the tax cuts that Donald Trump brought in back in 2017. But also, if we look at the kind of companies that we've got in the US stock market, then that gives us a clue as to why performance has been so strong as well. Now, what we're looking at here is the progress over the last 10 years that the big six tech companies in the US have made. So they used to be called the FAANGs. We probably need to get a new acronym for them because it doesn't quite work anymore, because Google's now called Alphabet, and Microsoft doesn't really fit in there. But these are Facebook, Apple, Amazon, Netflix, Google, and Microsoft. And together those six companies are now worth around $7 trillion. So just again to put that, I mean, it's a huge number, but to put it in some kind of perspective, earlier this year, Apple, one company in the US, albeit a big one, became more valuable than the entire UK stock market. So that kind of gives you an indication of just how big we're talking here. And then the kind of blue chart here shows the percentages that sorry, the orange line shows the percentage of the US stock market as measured by the S&P 500 that these companies make up. And you can see that it's at a pretty high level. So six companies currently making up for 25% of the US stock market. And again, that's really helped to drive the US stock market forward over the last 10 years, and indeed over the last year, because again, those companies have benefited from lockdowns. Amazon, Apple, Netflix, if you think about the services they provide, they benefit from us being locked inside, staring at our iPhones and buying stuff on the internet. Now, I think there are some probably warning signs in the US stock market, and I'd probably like to spend a little time looking at. One is this chart itself, the fact that six companies now make up 25% of the US stock market is itself a bit of a risk, because if you get a sector change there, something that rocks the share prices of those companies, it's going to have a wider effect on the US stock market. But I also think it was interesting to have a look at this chart here, which is a very widely watched chart which measures the valuation of the US stock market. What we're looking at here is the Shiller PE ratio. So this is a price earnings ratio for the US stock market. The slight difference from a normal price earnings ratio is it takes the price of the stock market and divides it by the earnings of companies in the stock market, not over 1 year, but over 10 years. So the idea is that you get a bit more of a rounded view, not distorted by any little blips that you get over the course of a year. So as I say, it's a very widely watched measure of valuation. And as you can see, currently it sits at a level of 33 times earnings. And it's only been higher than that twice before. One was very briefly in January 2018, just after Trump's tax cuts, and the other time was at the height of the dot-com boom in the late 90s, when valuations went through the roof. So you can also see on there the kind of 20s boom and the following the crash in 1929. One of the great things about this data is it goes back more than 100 years. And we've actually just gone past that level that was reached in just prior to the Wall Street crash in 1929. So, a bit of an amber warning signal there in terms of valuation. Now, I think it's probably fair to point out that, you could have made the same argument 3 or even 5 years ago, and, some of us did. And, if you'd made an investment decision on that basis, you would have, sat on the sidelines and watched the US go from strength to strength. And certainly, the trends that we've seen in the market seem to be very, kind of heavily ingrained. And we could yet see the US stock market, making gains from here. So, this is only one valuation metric, but I think it's an interesting one to look at, and as I say, a very widely watched one. We also have to be wary about the kind of monetary background that you've got behind what's going on in this chart. And if we look at the next slide, you can see what's happened to interest rates over the last 20 years. This is the US 10-year Treasury bond. And, the reason this has happened, of course, is that, we've got, quantitative easing and extremely low interest rates. So, in a world where, over 10 years, what you're getting from investing in a US Treasury bond is 1% a year, which is lower than the target rate of inflation of 2%, then it's easy to see why equities look attractive and the prices have been bid up, and why companies like the big tech companies, which some of them generating 20 to 30% earnings growth every year, why the prices of those got bid up. And I guess the question is, as it has been for the last 10 years, really, how long can this go on? And probably the answer is still for some time. It doesn't look like the central banks, particularly with so much economic pain still to come from the pandemic, are likely to try and turn the taps off and risk the economy in any way. So we could still see this environment for some time to come. But what I would say is that there will come a point when it will change, and at that point it could get more difficult for equity markets if bonds offer a proper alternative for investors, and perhaps particularly for some of the growth areas that we've seen over the last 10 years. So we'll just take it back to where we started to think about this and kind of the proportion of the market that's in the US, and just thinking about your own portfolios. If you were to have a globally weighted market portfolio, then you would have around 2/3 of your portfolio in the United States. Now, I suspect many of you probably aren't anywhere near that. And actually, that looks really pretty punchy from where I'm sitting for any country, unless you have a very, very, very strong opinion that it's going to be the best performer, and particularly in some of the kind of valuation measures that we've just been looking at. There is a premium price tag on that market at the moment. If we look at perhaps the other side of the coin, and just take a look at the UK. Again, just digging down a bit deeper into what's happened this year. So you can see that actually small caps and AIM stocks have had a pretty reasonable year, actually. And it's the big heavyweights of the FTSE 100, which have dragged prices down. And again, that's because you've got a lot of kind of financials and oil companies in that main blue chip index, which have been pretty badly hit by the pandemic. So again, if you kind of just zoom out on that and just look at performance over the last 10 years, again, FTSE 100 being a laggard, actually small caps and mid caps are doing pretty well. And actually, I think over the long term, it's pretty tried and tested. That's a very good area of the market to be in if you can withstand the extra choppiness that you get, and particularly if you're with an active fund manager, because that's an under-analyzed part of the stock market. So a good one for active fund managers to peddle their wares and use research to actually generate good stock selection and good outperformance. But the FTSE 100 still lagging down there, and I think looking at forward to 2021, I think actually that could be a different year for the FTSE 100. It could be a better year because that chart that I showed you right at the beginning, which is that we are expecting global economic expansion. And not necessarily to get us back to where we were before the pandemic, but in a way that doesn't matter so much to the market. What matters to the market is probably the direction of travel, and in that scenario, we could see the kind of companies, the financials, the oil companies that have had a bad time this year actually doing a bit better next year. Now, there is one fly in the ointment which I might mention. Some of you might have heard of this one. So the no deal question still, this morning it looks like it's no deal. Who knows what's going to be served up for breakfast tomorrow, but it's still going on, and it will have an effect on the UK stock market. So it's worth just pausing for a second. Just let's think about and reiterate how this plays out. So if there is no deal, then that's likely to mean a hit to the pound. That will be a one-off gain for companies that make lots of revenues overseas, so likes of Shell, Diageo, Unilever, those sort of companies. It will be bad for UK domestic stocks, so stuff like Marks and Spencers, Lloyd's Bank, things that are plugged into the UK economy, things like the house builders, for instance. So in that scenario, there's different parts of the UK market are going to perform very differently. And if there is a deal, as I said, not looking likely this morning, but who knows what tomorrow brings. If there is a deal, then you can flip that dynamic on its head. So the pound will rise. That will be a one-off hit to the share prices of the big international companies. By the same token, you would see greater confidence in UK domestic cyclical stocks. And if we get some resolution to Brexit this year, and that probably means deal, because I think no deal probably means we go back to the negotiating table at some point in the future. But if we get some resolution, and actually after that kind of one-off currency hit or boost, depending on where you sit, then actually it should be positive for all UK stocks, because it removes that big one-off currency risk. And I think you will probably find global managers and investors returning to the UK again, because they just don't have that one-off big risk. So that's kind of how things sit at the moment. That probably wraps up what I want to say this morning about markets, but I thought I'd just spend a little bit of time talking about a few of the other things that we've seen this year. One of them is just the huge amount of money that's been going into cash. So we saved 111 billion pounds in cash so far this year, a lot more than last year, and that's without including national savings and investment, which is another 40 billion pounds. So around 150 billion pounds, a huge tally. A remarkable achievement. What we can save when the pubs in this country are shut is quite amazing. But that's how we stand at the moment. I mean, the irony, of course, is that actually all of that is happening at a time when interest rates are at an unbelievably low ebb. Here are some of the kind of key interest rates that you've got. The average and best buys. If you consider that inflation is running at 0.7% and that's low, it's expected to go up next year, then cash is not looking like a very attractive place to be. Now, in terms of your own portfolios, then cash can be useful. If you know there's something that you will need to buy, a big purchase item in the next 5 years, cash is the way to go. Equally, you need to build up a cash emergency buffer, typically around 6 months of expenses. But once you've got beyond that, and actually, particularly when we're talking about retirement savings, if you're a long way from retirement, if you've got 10 years until retirement, then cash does not look attractive on a 10-year view, and you should probably think about, investing that at least partly in the market. So also looking at bonds, bonds in the UK not yielding very much at the moment either. So interest rates at a very low ebb. And at the same time, what we've got is, public sector debt rising, of course, because of the pandemic, building on, the debt that we've built up as a result of the financial crisis, which hasn't, really gone away. So the good news is that interest rates are low, but we now have gone through, 100% of GDP in terms of, public sector debt. And that is going to have to be paid back. So I'm afraid that does spell tax rises. So I think if you look at the amount of money that the Chancellor needs to get back, the OBR, the Office of Budget Responsibility, reckons anywhere between 27 billion and 102 billion. Quite a wide range there. It depends on how you define balancing the books. I suspect politicians will be tempted to take a lower figure, but even 27 billion is a huge amount of money to pull back. So if we think about the kind of taxes that might be, on the Chancellor's radar, I think he's going to be looking for stuff that's going to raise tax revenue without denting the economy too much. And wealth is generally less economically active than income. So I think taxes on wealth are going to look particularly attractive. Probably capital gains tax to me looks like a front runner. We recently had a report that was commissioned by the Chancellor that basically said that capital gains tax should go back up to income tax rates, and they should cut the annual exempt allowance from 12,300 to around 2 to 4K. So that's a big marker, and it wasn't that long ago, only 2008, when capital gains tax rates were the same as income tax rates. So it's not like it's breaking a taboo there. Pensions tax relief always does around in these kind of conversations. It's possible. It would require rewiring the entire pension system, but given the amount of money that the Chancellor needs to claw back, we shouldn't entirely rule it out. So next year looks like one that is going to be an important one for tax planning. I'm sure many of you already use your kind of pension and ISAs allowance, but those are very important tools against tax rises. And when is this going to happen? Well, if vaccines start to improve the economy and the health situation, then probably the March budget looks like a good set piece from which the Chancellor would probably look to launch a kind of fiscal repair plan. So just kind of summarizing a little bit. So broadly speaking, next year I think we're looking at economic growth, and that's positive for equity markets. There are some risks. So vaccines being slow to roll out, not coming to the rescue in time, possible second order economic effects. So unemployment rising, so we get an economic boom as stuff opens up, but then that unemployment weighs on things, and we end up with a double dip or triple dip recession. The US stock market valuation, which we've talked about quite a bit. Inflation, no sign of it really at the moment, but with all the money swirling around, if central banks lose control of inflation, that could be a problem, because they may then be forced to raise interest rates when they don't really want to combat it. And finally, taxation as well. So as I said, the government's probably going to look for ways to raise taxation without denting the economy, but we can still probably expect a little bit of a drag, because essentially that money will need to be paid back, and we've raided the future jam jar to pay for stuff now, and that's going to be a bit of a drag on the economy, however you cut it. So while we're talking about risk warnings, here's another one for you. That's pretty much it from me this morning. So thank you for listening to all of that.